The global economy was resilient through 2024, supported by the strong real income growth and a less restrictive monetary policy stance relative to 2023. In the first few months of 2025, trade frictions arising from an emerging tariff war, elevated global interest rates, and geopolitical tensions have heightened uncertainty about the global growth outlook. These uncertainties have weighed negatively on consumer and business confidence, softened investor sentiment, and increased downside risks to growth. The disinflation path has stalled in some advanced economies on the back of persistence in services inflation, resurgence in goods inflation, and the recent tariff actions by the U.S. The imposition of additional tariffs by the U.S. and retaliatory responses have pushed up long-term inflation expectations in some emerging market economies. In addition, the process of disinflation, which was expected to be supported by a decline in crude oil prices, be partly offset by the effect of the tariff increases. Against this backdrop, global inflation is expected to remain high in the near term. Global financial conditions also remain broadly restrictive, and this is driven by high monetary policy rates, rising long-term bond yields, declining capital flows to emerging markets and developing economies, and volatile equity markets. The Federal Reserve Bank of Japan, and Bank of England all kept their policy rates unchanged in March 2025 on account of rising trade and economic uncertainty, while the European Central Bank cut its policy rate to boost growth in the euro area. Expectations of higher for longer policy rates and rising uncertainty kept long-term bond yields high, while equity markets remain cautious due to concerns about the effects of tariffs. On the domestic front, ladies and gentlemen, growth continued to rebound, exceeding initial expectations. Provisional data from the Ghana Statistical Service estimated real GDP growth at 5.7% in 2024. And this was higher than the program growth rate of 4% for 2024 and the 3.1% recorded in 2023. Non-oil GDP grew at 6.0% compared with 3.6% recorded in 2023. The growth outturn in 2024 was driven by activities in the industry and services sectors. However, growth in the agri sector was slower, driven by lower crop yield due to adverse weather conditions, among other factors. The bank's real sector indicators point to a sustained improvement in economic activity amid significantly improved business and consumer sentiments. The updated composite index of economic activity, or what we call the CIA, rose by 5.7% year-on-year in January 2025 relative to 3.5% in the same period of 2024. And this was driven by increased consumption, international trade activities, and private sector credit growth. The confidence surveys conducted in February 2025 also showed significant improvement in both consumer and business sentiments, buoyed by expectations for an improved macroeconomic environment. On inflation, inflation remained high in 2024 and sticky around 23%, significantly higher than expectation. The latest data released by the Ghana Statistical Service indicates that headline inflation eased marginally from 23.8% in December 2024 to 23.1% in February 2025. And this was due to easing but still high non-food inflation. Food inflation has remained elevated, on the other hand, on account of unfavorable climatic conditions and other constraints. The bank's main core measure of inflation eased marginally in the first 2 months of 2025, and inflation excluding energy and utility items from the consumer basket eased from 23.1% in December 2024 to 22.4% in February 2025, and compared with 24% in the same period last year. This notwithstanding, latest inflation expectations as derived from the bank's model, the yield curve, and surveys all point to softening expectations, although still above the medium-term target. On private sector credit growth, credit is beginning to show signs of recovery. And in February 2025, private sector credit recorded 26.9% annual growth compared with 5.1% in February 2024. In real terms, credit growth was 3.1% compared with a decline of 14.7% in February 2024. Now, on the banking sector performance continued to improve. Total bank assets recorded 34% growth at the end of February 2025 relative to 12.1% growth in the same period last year. With regulatory reliefs, the banking industry's capital adequacy ratio, or what we call CAR, was higher at 14.4% compared to 13.6% in the same period last year. Without reliefs, however, the capital adequacy ratio was 12.1%. Now, on industry non-performing loans, the ratio declined to 22.6% in February 2025 from 24.6% in February 2024. Excluding the loans in the loss category, which are fully provisioned, the NPL ratio, as at end February 2025, was 8.9%. Overall, the financial soundness indicators showed broad improvements in asset growth, solvency, liquidity, efficiency, and profitability. Ladies and gentlemen, the fiscal policy stance was more expansionary than expected in 2024. The 2024 fiscal deficit on commitment basis was 7.9% of GDP against a target of 3.8% of GDP. And this was on the back of higher expenditures than target. This notwithstanding, early indications from banking sector data suggest some improvements in fiscal performance in early 2025. These, along with the commitment to fiscal consolidation as was presented in the 2025 budget, should support the fiscal outlook going forward. Also, the ratio of public debt declined, supported by the debt restructuring. Now, on prices of Ghana's major export commodities, these traded mixed on the international commodities market in early 2025. For example, gold prices crossed the $3,000 per fine ounce on March 14, 2025, on account of heightened economic uncertainty triggered by the trade and geopolitical tensions, persistent inflation, and weakening US dollar. In February 2025, gold prices averaged $2,897.3 per fine ounce, indicating a year-on-year growth of 9.7%. Similarly, crude oil prices recorded a marginal annual growth of 2.4% to settle at an average price of $74.95 per barrel. Cocoa prices, however, declined by 8.5%, driven by improving supply outlook for the current 2024-2025 season. The strong external sector performance in 2024 continued in early 2025, indicating a significant improvement in the accumulation of international reserves. In the first 2 months of 2025, the trade accounts recorded a surplus due to higher export receipts relative to imports. Total exports posted 50% annual growth to reach $4.3 billion. And this was driven by increased gold and cocoa exports arising from both price and volume effects. In contrast, crude oil exports declined as output from the 3 oil-producing fields fell. Total imports increased by 7.3% year-on-year to $2.7 billion. Consequently, ladies and gentlemen, international reserve accumulation met the IMF program expectation for 2026. In other words, the level of international reserves as at now is equivalent to where it should be under the program in 2026. The stock of gross international reserves at the end of February 2025 was 9.4 billion, which was enough to cover 4.2 months of imports of goods and services. This compares to the stock of 5.9 billion at the end of December 2024, equivalent to 4 months of imports of goods and services. The gross international reserves as defined under the IMF program, which excludes the encumbered assets as well as petroleum funds, increased to $6.9 billion, equivalent to 3 months of imports of goods and services in February 2025. The foreign exchange market, ladies and gentlemen, has continued to witness stability in recent months, and this has been aided by improved liquidity from remittance inflows and the domestic gold purchase program. The stability in the FX market is expected to remain, reflecting stronger reserve buffers and positive market sentiments. As of March 26, 2025, the Ghana cedi depreciated at a slower pace of 5.3% against the US dollar, compared to 7.6% in the same period of last year. In summary, ladies and gentlemen, the committee noted that the global environment has become more challenging, reflecting trade and economic policy uncertainty. The series of tariffs announced by the US administration is evolving and may have negative effects on the global economy. These developments have already triggered downgrades in GDP growth forecast in the 2 largest economies, and that is talking about the US and China, and in turn, global growth. In addition, the disinflation process appears to have stalled in some countries, while financial conditions remain broadly restrictive as central banks slow the pace of monetary policy easing. The persistence of these external headwinds may spill over to the domestic economy through the trade and financial channels, highlighting the need for policy to remain proactive. On the domestic front, ladies and gentlemen, early indications point to improved growth prospects. The bank's CIEA rebounded, and the Ghana Purchasing Managers Index moved above the 50 benchmark in February. implying increases in new orders by companies. Both the business and consumer confidence have improved, and private sector credit growth is recovering. These developments suggest a positive outlook for the economy going forward. On the external sector, the outlook for the sector remains strong. This is against the backdrop of increases in gold exports driven by sustained implementation of the Gold for Reserve program, continued growth in remittance inflows, and commitment to the implementation of policies and reforms under the IMF program. In the outlook, the continued buildup of reserve buffers is expected to support the stability of the currency. And the banking sector has also remained broadly stable. Credit risks within the banking sector, however, remain elevated, as underscored by increased non-performing loan ratios. The bank's latest macroprudential risk assessment indicates some moderation in systemic risk on the back of improved solvency, liquidity efficiency, and profitability. Going forward, the bank will have to continue to closely monitor undercapitalized banks to safeguard the stability and soundness of the banking sector. The committee observed that the fiscal stance was expansionary in 2024, and this has created significant fiscal impulses and a liquidity overhang that needs to be carefully managed. The strong liquidity conditions could spill over into other segments of the economy and derail the disinflation path. While the government has signaled a strong commitment to fiscal consolidation, monetary policy restraint, we think, is required going forward. Now, while headline inflation has declined marginally, it remains a concern. Both food and non-food inflation are significantly above expectation, and core inflation remains elevated. While food inflation was driven largely by supply-side factors, preventing the second-round effects from such increases will be essential. The persistent inflation dynamics over the past year, partly driven by both fiscal and monetary policy missteps, will require a policy reset to re-anchor the disinflation process. Now, to restore price stability going forward will require a tight monetary policy stance, strong liquidity management, and commitment to the 2025 budget, which seeks to reset the fiscal consolidation process. Now, on the monetary policy decision, under the circumstances, the committee, by a majority decision, and I mentioned majority decision, for the first time we are using a majority decision, unlike the unanimous decisions we have used in the last many years since the framework began. And so by a majority decision, the committee decided to raise the monetary policy rate by 100 basis points to 28%, and this is meant to re-anchor the disinflation process. As inflation becomes firmly anchored, and I want to emphasize that, as inflation becomes firmly anchored, as we see the next readings of inflation and we see declines, the committee will reassess the scope for a gradual easing in the policy stance. Now, let me say a few words on the additional operational measures. As usual, apart from the monetary policy decision itself, we often also announce a number of operational measures. Now, so in addition to the adjustment in the policy rate, we are implementing some complementary measures which are meant to strengthen liquidity management and enhance monetary policy transmission. And I want to give you three of those. First is we are introducing a longer dated 273-day instrument which is meant to augment the existing sterilization toolkit. Secondly, we plan to intensify the monitoring of banks' net open positions to ensure compliance. And now all this is meant to ensure stability in the FX markets. Then the last one is to review the current structure of the cash reserve ratio. You know, there's the dynamic ratio, and there are also those high levels that have been maintained. And we want to assess its broader impact on liquidity conditions and financial intermediation in the economy.